When most people think of organized crime, images of smoky backrooms, clandestine deals, and mob bosses in sharp suits come to mind. Rarely do they connect the mafia with Wall Street, the pinnacle of legitimate finance. Yet the origins of modern finance are in part intertwined with criminal ingenuity, influence, and ruthlessness. To understand this connection, we must trace the rise of the five families of New York: the Genovese, Gambino, Lucchese, Bonanno, and Colombo families, and their early incursions into the financial world. The five families were formally organized during the 1930s after the Castellamare War, a violent struggle for control over New York's Italian-American underworld. Once the smoke cleared, these families diversified. They moved beyond the typical rackets, gambling, loan sharking, and bootlegging, into more sophisticated enterprises, including labor unions, construction, and ultimately, finance. Why finance? Because money, whether clean or dirty, wields power. During the post-Prohibition era, the stock market exploded. The 1929 crash and subsequent Great Depression left many ordinary investors vulnerable and desperate. The mob recognized opportunity here. Through complex networks of shell corporations, insider information, and intimidation tactics, organized crime began influencing stock prices. One tactic was pump and dump, a scheme where mob-backed entities would inflate the value of certain stocks, often of small, thinly traded companies, then sell at a profit once unsuspecting investors bought in. This method, though illegal, was difficult to trace in an era before modern securities regulations. The mob's involvement in Wall Street was not just opportunistic, it was symbiotic. Many financial firms needed liquidity, and the mob had cash. Banks and brokerage firms sometimes turned a blind eye to the source of funds, especially when big returns were promised. This cooperation created a feedback loop where criminal capital could enter legitimate markets, giving mob families unprecedented economic leverage. Another critical avenue for mob influence was control over labor unions. At its peak, the mafia had significant sway over the Teamsters, the International Longshoremen's Association, and the United Auto Workers. Union pension funds, enormous pools of capital, became vehicles for mob-backed investment schemes. Through these funds, the mob indirectly funded construction projects, corporate acquisitions, and sometimes outright stock manipulation. In essence, organized crime was no longer confined to alleyways and casinos. It had moved into boardrooms and investment portfolios. Perhaps the most infamous connection between Wall Street and the mob was the stock fraud schemes of the 1960s and 1970s. During this era, several mobsters infiltrated brokerage firms, exploiting lax oversight. Shell companies were set up to create the illusion of legitimacy, while inside traders tipped off mob associates to profitable trades. Legal investigations later revealed that millions were siphoned from unsuspecting investors. While prosecutions occurred, they only scratched the surface. Many of the schemes were too sophisticated or too well-connected to fully unravel. The mob's impact on financial institutions extended beyond direct fraud. Their very presence fostered a culture of intimidation and secrecy. Brokers and financiers who were not mob-affiliated often avoided challenging corrupt schemes out of fear of retaliation. This environment made it easier for criminal capital to move freely within the market, further entrenching mob influence. By the 1980s, the image of Wall Street as a purely legitimate institution began to crumble. Scandals, from insider trading at major firms to leveraged buyouts connected to dubious sources of funding, hinted that the legacy of mob involvement was not entirely eradicated. Even as law enforcement and regulatory agencies increased scrutiny, organized crime adapted, moving operations into new sectors, including international finance, real estate, and derivatives markets. In today's financial world, the echoes of this mob influence are still detectable. The networks, relationships, and strategies developed decades ago laid the groundwork for modern financial manipulation techniques. Understanding this history is crucial because it reminds us that financial institutions are not infallible. They are human systems, vulnerable to corruption, coercion, and the persistent lure of unchecked power. The Five Families. Legacy in finance is not about overt mobsters walking into Goldman Sachs or J.P. Morgan boardrooms with Tommy guns. It is about subtle influence, embedded networks, and the ability to leverage capital for both legitimate and illicit purposes. What began as street-level extortion evolved into a shadow empire influencing global markets, leaving questions about trust and transparency in the financial system that remain today. The transition from traditional rackets to sophisticated financial manipulation was neither accidental nor purely opportunistic. It was strategic. Organized crime understood early that controlling money meant controlling influence, and Wall Street provided the perfect playground. One of the primary mechanisms of mob influence in finance was the use of shell corporations. These legal entities, often incorporated in tax-friendly jurisdictions or loosely regulated states, provided a front for illegal activity. Mob-controlled businesses could funnel illicit cash into legitimate investments without immediate detection. These funds were often used to manipulate stock prices, buy real estate, or invest in high-yield ventures, all while appearing above board to regulators and the public. Insider trading was another tool. In the 1960s and 1970s, mobsters cultivated relationships with unscrupulous brokers, accountants, and corporate executives. Through these networks, they gained access to non-public information that could be leveraged for massive profits. While insider trading is illegal today, enforcement in earlier decades was inconsistent, and mob families exploited the loopholes. Deals were often made in smoke-filled offices or private clubs, far from the prying eyes of regulators. Labor unions continued to serve as a critical conduit. By controlling pension funds and union investments, the mob could direct capital into projects that benefited their interests. This influence often extended to real estate developments, construction contracts, and municipal projects. The result was a blending of legitimate infrastructure growth with organized crime's strategic financial gain. The rise of complex financial instruments in the 1980s, including derivatives and leveraged buyouts, provided yet another avenue. Organized crime families invested indirectly in these products, sometimes partnering with seemingly legitimate hedge funds or private equity firms. This allowed them to diversify their holdings, obscure the origins of their capital, and exploit market volatility for profit. Perhaps most importantly, the mob's presence instilled a culture of intimidation and risk manipulation. Brokers, executives, and investors who refused to cooperate with mob-linked schemes faced consequences ranging from financial sabotage to personal threats. This coercive environment ensured compliance, often without a single transaction crossing into the realm of outright violence. Psychological leverage, in this sense, was as potent as physical force. Modern examples of financial manipulation bear striking similarities to these historical mob tactics. High-frequency trading, pump-and-dump schemes in penny stocks, and complex offshore investment structures all mirror the strategies pioneered decades ago. While technology has changed the execution, the underlying principles, control, secrecy, and leverage, remain the same. If you confirm this style and depth, I can continue with fully connecting historical influence to modern financial institutions and demonstrating how the Five Families' legacy persists today. Do you want me to proceed with the remaining parts now? By the late 20th century, the influence of the Five Families had evolved from the streets of New York to the towering glass and steel structures of Wall Street. No longer confined to direct extortion or overt racketeering, organized crime leveraged decades of experience to operate in the shadows of legitimate finance. The skills they honed in controlling unions, manipulating small companies, and orchestrating insider trades became directly applicable to complex modern markets. One of the clearest examples of this evolution is the infiltration of real estate markets. For decades, the mafia invested heavily in Manhattan and New York's surrounding boroughs. Using a combination of cash flows from illicit activities and legal investments through shell companies, they purchased properties, funded construction projects, and sometimes influenced zoning and city approvals. This allowed them not only to generate massive returns, but also to wield political and economic leverage over entire neighborhoods. Many of these investments were eventually absorbed into larger corporate entities or held through partnerships with legitimate financial firms, blurring the lines between criminal and conventional capital. In parallel, organized crime families became adept at exploiting weaknesses in the banking system. Money laundering operations, traditionally aimed at cleaning illicit cash from gambling or narcotics, shifted toward more sophisticated methods. Layering transactions through multiple accounts, offshore shell companies, and seemingly legitimate business ventures, the mob could move vast sums of money with little detection. Over time, some of these laundering techniques laid the groundwork for contemporary financial strategies used by hedge funds, private equity firms, and multinational corporations to shield assets from scrutiny. Although in legal contexts today, such methods are heavily regulated. The mob's involvement with unions also left a lasting legacy. The Teamsters, for example, controlled one of the largest pension funds in the United States. Organized crime figures had access to these enormous pools of capital, directing investments into projects that served both legitimate business purposes and their own financial interests. This duality, operating in both legal and illicit spheres, was emblematic of the modern financial environment, where complex layers of corporate structures often obscure the true source and intent of capital. Insider trading, a practice pioneered in the 1960s with mob involvement, evolved into sophisticated schemes in today's markets. While regulations such as the Securities Exchange Act and enforcement by the SEC curbed blatant abuses, the principle remains: information is power. In contemporary finance, private equity firms, venture capital funds, and institutional investors leverage confidential information to gain an edge. While these practices are legal when properly disclosed, they mirror the mob's historical strategy of exploiting insider knowledge to profit, demonstrating how techniques rooted in criminal finance can be adapted for legitimacy. The most striking continuation of mob influence in modern finance may be cultural rather than structural. Organized crime families instilled a mindset of opportunistic risk-taking, secrecy, and strategic manipulation. Today's financial professionals, whether in trading, investment banking, or hedge funds, operate in a world that prizes leverage, networks, and complex schemes, principles that are surprisingly similar to the mob's operational ethos. The difference is that now these practices are cloaked in legality, compliance, and public relations, making the underlying strategies almost invisible to ordinary investors. Globalization further amplified this influence. The mafia, like many organized crime networks, adapted to international markets, moving capital across borders to exploit regulatory gaps. Shell corporations in the Cayman Islands, trusts in Liechtenstein, and complex derivatives markets provided mechanisms to obscure the origin and movement of funds. While these actions are largely legal today when structured correctly, they echo the mobility, discretion, and financial ingenuity once reserved for criminal enterprises. Even in recent decades, financial scandals reveal the fingerprints of historical mob techniques. Pump-and-dump schemes in microcap stocks, fraudulent hedge fund operations, and offshore tax evasion all mirror the strategies the five families perfected decades earlier. While enforcement has improved, The persistence of these schemes suggests that certain foundational strategies of manipulation, secrecy, and capital leverage remain embedded in financial culture. Perhaps most importantly, the story of the mob's influence on Wall Street challenges the perception of finance as a purely meritocratic, transparent system. While regulations, audits, and oversight exist, the legacy of organized crime serves as a cautionary tale. Wealth and influence are not always generated through fair competition. Networks, connections, and the ability to exploit opaque systems often matter as much, or more, than talent or strategy. In examining the modern financial system, it becomes clear that the shadow of the five families is not one of direct mobsters walking into trading floors, but of strategies, structures, and methods that persist. Today's financial world, global, digital, and complex, is the natural extension of the networks the mob established decades ago. From real estate empires to pension fund manipulation, from shell companies to insider strategies, the five families' fingerprints remain embedded in the mechanisms that govern wealth and power. The lesson is both unsettling and enlightening. Understanding the criminal origins of certain financial practices provides insight into vulnerabilities, motivations, and behaviors that continue to shape markets. It reveals that, despite appearances, the systems we trust daily, banks, investment firms, and financial regulators, operate on foundations influenced, at least in part, by ingenuity once used for criminal gain. This completes Part 3 at roughly 800 words, bridging historical mob activity to modern finance while highlighting ongoing influence. If you like, I can continue directly with Part 4, 800 words, focusing on high-profile modern examples and case studies that illustrate the enduring connection between the five families and current financial institutions. Do you want me to continue with Part even decades after their rise to prominence? The legacy of the five families persists in subtle but tangible ways throughout the financial world. While most modern markets are highly regulated and closely monitored, the methods and influence cultivated by organized crime decades ago created structures and loopholes that continue to be exploited today. Examining specific case studies reveals the enduring nature of this shadow influence. One of the most illustrative examples comes from New York's real estate boom in the 1980s and 1990s. The city experienced unprecedented growth, fueled by foreign investments, deregulated lending, and high-yield development projects. Many of these deals, while legitimate on the surface, were structured in ways that mirrored historical mob strategies. Complex ownership chains, shell corporations, and partnerships with nominally independent entities allowed wealthy investors, some with mob connections, to conceal both the source of capital and the beneficiaries of profits. In several instances, federal investigations later revealed that real estate transactions were funded, at least in part, by capital originating from organized crime or laundering operations. A particularly striking case involves Manhattan's Garment District, long a hub for both small business entrepreneurs and criminal networks. Organized crime families historically controlled trucking, distribution, and labor unions in the area. When development projects or investment opportunities arose, mob-linked investors often leveraged their control over labor and property to secure favorable deals. Even in today's corporate real estate environment, vestiges of this influence remain in the form of opaque partnerships, complicated financing arrangements, and the ability of large investors to negotiate favorable terms using social or economic leverage, principles honed decades ago in the mob's financial playbook. Financial markets themselves have not been immune. Consider the rise of micro-cap stocks, penny stocks, and highly speculative investments. Many modern pump-and-dump schemes bear an uncanny resemblance to strategies perfected by organized crime in the mid-20th century. Sophisticated actors use digital tools and high-frequency trading algorithms instead of smoke-filled back offices, but the underlying tactic is the same: artificially inflate the value of a company, sell at a profit, and leave unsuspecting investors holding the bag. Regulatory agencies like the SEC and FINRA have cracked down on some of these schemes, but the historical precedent set by the five families demonstrates how deeply these methods are embedded in financial culture. Even seemingly modern innovations, such as hedge funds and private equity structures, can echo the mob's operational strategies. Layered investments, limited partnerships, and off-balance sheet vehicles all allow investors to shield sources of capital, minimize risk exposure, and maintain secrecy. Tactics not unlike those the mafia used decades ago. While these structures are legal when properly disclosed, they highlight how principles of leverage, risk management, and secrecy cultivated in criminal contexts can be seamlessly integrated into legitimate finance. Another compelling example lies in the influence of organized crime over union-managed pension funds. The Teamsters Pension Fund, historically controlled in part by mob-influenced trustees, provided capital for various development projects, corporate takeovers, and real estate investments. Although federal oversight and reforms have significantly reduced the ability of criminal actors to control these funds today, the historical precedent illustrates the enormous economic power unions wielded, and how organized crime was able to channel that power for profit. Lessons from these cases continue to inform regulatory approaches and risk management strategies in financial institutions. International finance also provides clear echoes of the mob's influence. The globalization of markets created opportunities to move capital across borders, exploit regulatory gaps, and use offshore structures to obscure financial flows. Tax havens, shell companies, and complex derivatives all provide legitimate means of achieving objectives once exclusively leveraged by organized crime. In fact, some analysts argue that certain modern financial scandals, including high-profile money laundering cases and the use of corporate opacity and tax optimization, are essentially an evolution of the same strategies the five families used decades ago, now adapted to a global, digitalized economy. Finally, the psychological and cultural influence of the mob cannot be underestimated. Organized crime's methods emphasized networking, strategic relationships, and leveraging access and information for advantage. These same principles underlie modern financial success, particularly in hedge funds, investment banking, and private equity. While the context has shifted from illegal coercion to legal influence and negotiation, the foundational mindset, identify opportunity, consolidate power, and control information, remains remarkably similar. By examining these case studies, it becomes evident that the legacy of the five families is not limited to historical footnotes. Instead, it represents a set of strategies, cultural norms, and operational methods that continue to shape financial behavior. Investors, regulators, and financial professionals operate in an environment influenced by decades of experience in both legal and illicit finance, a reminder that power, influence, and money have always been intertwined, regardless of the legality of the source. Ultimately, these examples highlight a critical truth. Modern financial institutions, while ostensibly transparent and regulated, operate on systems that were historically vulnerable to manipulation. Understanding the interplay between organized crime and legitimate finance offers insight into both the resilience and the fragility of these institutions. The lessons of history remain relevant today, guiding how we perceive, regulate, and trust financial markets. Do you want me to proceed with? As we reach the conclusion of this exploration, it's clear that the influence of the five families on finance is more than historical curiosity. It is a lens through which we can better understand modern financial systems. While no one expects mobsters to stroll into today's Goldman Sachs or J.P. Morgan boardrooms with a briefcase full of cash, the strategies, networks, and psychological levers developed decades ago continue to shape markets, investment behaviors, and institutional structures. One of the most significant implications is the persistence of opaque financial structures. Complex corporate entities, offshore trusts, and layered investment vehicles, tools that trace their roots to mob-laid foundations, allow modern financial actors to obscure the origin and intent of capital. While these structures are legal when properly disclosed, they also create vulnerabilities. Regulators struggle to trace ownership, investors cannot always fully assess risk, and the potential for exploitation remains. In this sense, the legacy of organized crime persists, not through overt control, but through the very architecture of modern finance. Insider knowledge and information asymmetry, another core principle once exploited by the mob, remains central to financial advantage. Today's traders, fund managers, and institutional investors operate in markets where speed, access, and intelligence determine profitability. While legal frameworks now exist to limit unfair advantages, the basic strategy, leveraging knowledge that others lack, mirrors tactics perfected by mobsters decades earlier. The only difference is that modern actors employ algorithms, data analytics, and sophisticated financial instruments, instead of backroom deals and personal threats. Labor influence and pension funds offer another lens into the enduring legacy. Though reforms have curtailed organized crime's ability to control unions, pension funds remain a massive source of capital for corporate investments, real estate, and infrastructure projects. These funds continue to operate in a dual capacity. They are both a tool for public benefit and a mechanism through which significant financial leverage can be applied. The principle remains the same as in the mid-20th century. Controlling large pools of capital grants influence over markets, institutions, and even political decisions. Globalization further complicates the picture. Capital moves across borders with ease, creating opportunities to exploit regulatory gaps, tax incentives, and differences in oversight. Organized crime's early experience in moving money, structuring offshore entities, and navigating regulatory blind spots presage the tools and techniques now commonplace in international finance. In other words, the globalization of finance has, perhaps unintentionally, validated strategies once employed exclusively for illicit gain. But beyond technical methods, the psychological and cultural imprint of organized crime persists. The five families cultivated an ethos of calculated risk, strategic networking, and leveraging access, principles that underpin modern financial success. In hedge funds, venture capital, and private equity, those who can identify opportunity, consolidate influence, and control information often succeed, much like mob families did in the mid-20th century. This cultural continuity shows that influence and power, more than legality, have always driven financial outcomes. The lessons for today's investors and institutions are profound. First, transparency and oversight are not optional, they are essential. Markets thrive when participants can trust that capital flows are legitimate, disclosures are accurate, and rules are enforced. Understanding the historical infiltration of finance by organized crime highlights why regulation exists and why vigilance is critical. Second, recognizing the potential for systemic vulnerability allows for better risk management. Just as the mob exploited weaknesses in unions, stock markets, and real estate, modern financial systems remain susceptible to manipulation through cybercrime, shadow banking, and regulatory arbitrage. Awareness of these historical precedents encourages institutions to anticipate, detect, and mitigate potential threats before they escalate. Finally, this history challenges the assumption that finance is inherently meritocratic or fair. Networks, influence, and strategic leverage often determine outcomes as much as skill or insight. The five families' legacy reminds us that money is not just a tool, it is a source of power, capable of shaping entire industries, political landscapes, and communities. In conclusion, Wall Street's mob roots are not merely a sensational story. They are a cautionary tale and a guide for understanding modern finance. From shell corporations and insider trading to pension fund influence and global capital flows, the echoes of organized crime remain embedded in the very systems we trust daily. The five families did not just influence markets, they helped shape the principles of risk, leverage, and strategic control that define finance today. By studying this history, investors, regulators, and ordinary citizens gain insight into both the potential and the peril inherent in financial systems. The legacy of the five families serves as a reminder. Vigilance, transparency, and ethical oversight are not just abstract ideals. They are practical necessities in a world where the lessons of the past continue to shape the fortunes of the present. Understanding the intersection of crime and finance also encourages critical thinking about power structures, wealth accumulation, and institutional trust. In a society that increasingly relies on complex financial systems, acknowledging these historical connections ensures that the mistakes and manipulations of the past are not silently repeated in the present. Ultimately, the story of Wall Street's mob roots is not just about crime. It is about influence, innovation, and the enduring human drive to gain power through control of resources. The five families may no longer run the streets of New York as they once did, but their strategies, lessons, and methods live on in the architecture of modern finance, shaping markets, guiding decisions, and reminding us that the line between legitimate and illicit influence is often thinner than we might assume.